One thing is evident, the bond market is telling you that inflation has peaked out. If inflation has peaked out, bond yields have come down. Bond yields last I checked was sub 7%. They'd gone to 7.5 or 7.6 earlier this year. But bond yields coming below 7%, academically what it means and what it means for fixed income investors. Let's take that conversation forward. And Amandeep Chopra, President, Head Fixed Income with UTI Asset Management, and you've got Neeraj Gambhir, Group Executive and Treasury Head and Markets, Wholesale Banking with Axis Bank. So good to have both of you back on ET Now. Neeraj, in simple terms, if you have to break it for our viewers, that bond yields have come below 7%. What does that mean?
So I think we are now looking at an environment where inflation is expected to steadily come down over the next 12 months. Our forecast for the inflation is that we will be somewhere close to 5% or a shade below 5% on an average for the rest of this year. We are also expecting Reserve Bank to stay on hold, no further changes in the monetary policy rates, at least for the foreseeable future. Reserve Bank clearly is very data dependent, while RBI Governor said in the last MPC review that it is a pause, not a pivot. I think this is likely to be a far more extended pause. So the unprecedented and sharp rate hikes that we saw in the last fiscal year, I think, are behind us. We're looking at a fairly stable rate regime, at least for the next few months, at least for the next 6 months, is my guess. And thereafter, we'll see how the inflation settles down and what happens to the demand.
Amandeep, how should one understand from in fixed income market standpoint, this decline in bond yields? Do you think this is something which has come as a bit of a surprise, and the upside in the fixed income market right now has just about started?
I would think so, yes. I mean, if you really look at the key drivers for the sharp rally we've seen, it's clearly been driven, like Neeraj mentioned, the pause by RBI, which was well against what the market was expecting in April. Since then, actually, most of the drivers of inflation have been softening. If you just look at crude, it's down by 13.5% since the last inflation print came in. Globally, the food prices, as measured by the Food and Agriculture Organization Index, is down significantly by another 20-odd%. So I guess if you look at the key drivers, commodities, food, even domestically, a high base effect, clearly are auguring very well as far as inflation trajectory is concerned. In fact, the markets presently are looking at maybe an undershoot as far as RBI's own CPI estimates are concerned for the current year. So I guess all this does support a rally in the yields. What I guess we'll have to watch out for is that do some of these trends reverse going forward or not? So to some extent, one could say that, there is some degree of a flow in terms of how far the 10-year yield can rally from here on. We do have some concerns around the monsoons, which can again maybe reverse some of these benefits we've seen in terms of food. Secondly, if you look at global commodity prices, a lot of it is also influenced by the broader economic outlook, combined with the fact that there was a fair degree of expectation that China will maybe resurge in terms of its growth and could again propel commodity prices up. That's really not happening. And the Chinese government is not really spending anything much in terms of stimulating the economy. So very good as far as commodity prices are concerned. So I guess all this does dovetail into a very benign outlook on rates.
Amandeep, would you, therefore say that to a certain extent that yields have peaked, at least in the medium term? And with regards to yields, what do you believe are some of the key factors as well that are contributing to this decline? Would it be any factors outside of the global events, Neeraj?
So I think it looks like that the worst is behind us as far as the rate hiking cycle is concerned. Key factors to watch out for, I think, will be how inflation plays out from here onwards. As I mentioned earlier, that our estimate is that inflation for this financial year is going to average at close to 5%. 5% is still higher than the RBI's target of 4%, but we are going to see a steady decline. At least for the next few months, we will see benign inflation prints. From a global standpoint, I think the markets are currently expecting Fed to get into a pause, whereas ECB and Bank of England are likely to stay the course as far as rate hikes are concerned. But Fed pause, how extended the pause is, and whether that pause will eventually turn into a cycle of rate cuts starting in the second half of this year remains to be seen. If you look at the market pricing, there is an expectation that the rate cuts will start as early as maybe September. But I think the Fed's own sort of communication, what the Fed speak from the Fed governors, all of that are indicating that we're probably in a much more extended pause at this point in time rather than a cycle of rate cuts. So global factors will continue to weigh. Commodity prices, crude oil prices are the important factors. If there is a rebound in global demand somewhere in the second half of this year, that could have an impact. But at this point in time, looking at the data and looking at all the various variables that we've talked about, and Amandeep has also mentioned, it does feel like that we are in an extended pause of rates, both in India as well as in US.
What could be the implications of what is happening in US? The commercial real estate there is under stress. US regional banks will be forced to lend less. Job layoffs by big tech has started, which means that the global growth in the second half of this year, now whether it is hard landing or soft landing, that is debatable, but ultimately, Amandeep, things are looking bad for global markets. Do you think what is looking like a pause right now, 6 months from now, you could be staring at a situation of rate cut?
Banks are clearly not signaling any sort of near-term pivot, but the markets are already pricing in a much earlier change as far as the policy rate trajectory is concerned. So if you look at it, while there are arguments around recession or soft landing and hard landing and so on, but when you look at the IMF's own forecast for global growth, it's actually halved. But it's not materially moved much for the developed markets, right? From 3.4, they've now brought it down to 1.7. They're not indicating a recession or some degree of negative GDP growth there. The good part is for emerging markets or developing markets, the growth estimates still remain pretty much around 4.9 to 5%. So to some extent, global growth is slowing down as you look ahead, but it's possibly a 1 to 1.5 year phenomena. Forecasts for 2024 onwards are slightly upward sloping. So yes, to some extent, you will see the cycle turning very soon. The question is when, and I think this is where the markets and the central banks do differ. Like Neeraj mentioned, the central banks are not in any way indicating that they're in a hurry to start cutting rates so soon. Maybe they will wait and watch for some of the data which have driven this dovishness really be more consistent and more relevant. And on the other side, markets believe that the pivot will take place very soon because you may actually see a much sharper reversal in growth outlook. So I guess to that extent, yes, you do still have this bit of a push and pull between the markets and the central banks.
Neeraj, the more I look at the framework of what Indian central bank has done versus what global central bankers are doing, the framework of inflation, the framework of growth, do you think we are now reaching a point where now the Indian monetary policy will be largely independent of what is happening in the world? I mean, earlier we were joined at the hip because of the size of the US economy, but I'm getting a sense, at least in last couple of credit policy, that a divergence now seems to be appearing.
So if you see, we were probably the first major central bank to pause after Reserve Bank of Australia. Reserve Bank of Australia has gone back to a hike, but we expect to be in a pause mode for some more time. So in that sense, Reserve Bank of India has taken a slightly different view than the global cycle. One of the key factors which kind of links us up with the rest of the world, and particularly with the developed economies, is the impact on currency. Rupee has been fairly stable. Our own estimates of current account deficit as well as the balance of payments balance have actually quite significantly changed over the last 6 months. I think instead of a deficit on balance of payments for this year, we are now forecasting a mild surplus. That kind of situation and the resumption of capital flows, particularly in equities, give Reserve Bank the ability to take a slightly different view as far as the domestic monetary policy is concerned. Once the capital flows, resume or they have resumed, the current account deficit is no longer a serious problem. Then the central bank can actually move on to look at the domestic economy independently and look at the domestic policy independent of what's happening in the rest of the world. So I think that enabler in some senses has been put in place over the last, I would say, 6 odd months.
Right. And finally, Amandeep, wanted to get an outlook from you because, in relative terms, India has managed to do quite well compared to global rates, with the US 10-year yield at about 3.5%. What do you think will be the new normal in a higher interest rate environment globally for the Indian 10-year bond yield?
It's tough to give, a precise level, but I would say a band where you could expect something like 100 basis point over the policy rate would be desirable. This is in the backdrop of the fact that, clearly the central bank today is focusing on real policy rates and real rates for investors and savers. And on the other side, I guess, given the supply that we will see for the rest of this, quarter and the 6-month period ending September, there is a possibility that, any sort of compression in the spreads may not be desirable. So to some extent, your expectation of where you think the policy rate could settle, if it's say 6%, then maybe 75 to 100 basis point of spread over that would be a likely band for the 10-year.
Appreciate your time, gentlemen. Neeraj as well as Amandeep. Thank you for joining in and sharing your thoughts.